Welcome back to Investing Talk Podcast.
Today we're looking at VivoPower.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis of VivoPower.
Yeah.
On the surface, if you just, look at the last fiscal year, FY25,
Yeah.
the headline revenue number is tiny, just $61,000.
That's basically zero in corporate terms.
It is. But the whole story here is the dramatic restructuring that those numbers are actually hiding.
Okay, let's unpack that right away, because that tiny top line, it's deliberate.
Exactly.
Management is aggressively shifting away from those old capital-intensive solar development and EPC activities.
Right. And for anyone who doesn't know, EPC is engineering, procurement, and construction.
And those deals require a ton of upfront cash for really low commoditized margins.
Precisely. They are shedding that entire line of business to become, well, a capital-light, IP-rich enterprise.
And the numbers back that up.
The financial results absolutely confirm this. The net loss, it shrunk by about 73% year over year.
Wow.
Improving to roughly $12.8 million. That aggressive cost-cutting, it just shows they are slamming the brakes on the old model while pivoting to three really distinct high-margin platforms.
And those three platforms are the whole story here. We're talking about EV conversions through their subsidiary Tembo,
Right.
digital twin tech through Carrot Digital,
Right.
and then this totally new move into digital asset management with Vivo Federation.
And that mix shift is just so crucial. It lets them generate revenue from intellectual property and services, which structurally lifts their gross margins and radically reduces the amount of working capital they need.
And balance sheet repair is key for a small cap like this.
Oh, critical. And management already believes they've regained their Nasdaq equity compliance. They're projecting a pro forma net equity of around $20 million as of this May.
So that addresses a huge risk overhang that sinks a lot of these smaller companies.
It does.
Okay, that's essential context. But let's get into where the real value proposition is, because this is where the asymmetry seems immense.
Right.
This is a company with a market cap around $40 million. They're not doing buybacks. They're using these big corporate actions to try to unlock massive value.
That is the core thesis. And the first piece of that puzzle is Carrot Digital.
Okay.
Carrot is all about high-tech stuff. Digital twin, AI, data IP. If you're not familiar with digital twin, just think of it as a complex virtual replica of a real-world asset.
Like a power plant or a vehicle fleet.
Exactly. A power plant, a fleet, even an entire city grid. You use it to simulate, test, and optimize performance in real time. It's very high-value enterprise software.
So it's real IP that helps major industrial clients cut their operating costs.
Absolutely. And this whole division is being prepped for a direct Nasdaq Q IPO.
And the valuation they're targeting.
The target valuation for that spinoff, based on their internal estimates, is immense, around $308 million.
Okay, stop right there. $308 million. That number alone just dwarfs the entire company's $40 million market cap.
It does.
But how does that spinoff actually transfer value to the investors holding the stock today? That's the mechanism we need to make really clear.
It's done through a distribution. So, critically, shareholders of record on July 9th, 2025 are set to receive 5 Carrot Digital shares for every single VivoPower share they own.
Let me just highlight that for you, the listener. This is like handing investors a hidden equity stub.
A great way to put it.
Imagine you own a house, and the whole house is valued at $40,000. But the homeowner, VivoPower, tells you they're taking the garage, which they think is worth $300,000, and giving you the shares in that new separate garage business.
And you still own your original house shares.
Right, but now you also own a big piece of the separately listed high-tech business.
A business potentially valued multiples, higher than the entire company is today. It's a pure, non-dilutive value transfer. It's designed to get around that conglomerate discount the market is applying.
Okay, so that's one massive value unlock. But then there's the Tembo ELV division, the EV conversion business. That's also slated for a major transaction, right?
It is. So Tembo, they specialize in electrifying light vehicles, but for really heavy-duty, rugged fleets, like mining, infrastructure, utilities, places where a normal road EV just wouldn't survive.
So a very specialized niche.
Very specialized market, which creates a strong technology moat around what they do.
And the monetization plan here is a SPAC, a special purpose acquisition company.
That's right. Tembo is moving toward a SPAC transaction where a couple called Energy plans to acquire 51% of the business.
Yeah.
And the implied enterprise value for that deal is $200 million.
So the market, or at least the SPAC partner, is basically validating Tembo's tech at a $200 million valuation. So you add that to the $308 million for Carre. I mean, the implied value of just two of their assets is over $500 million. The gap between that and the current valuation is just astonishing.
And if those two deals, the Carrot IPO and the Tembo SPAC, if they close anywhere near those indicated valuations,
Yeah.
they alone could justify a value so much higher than the current 40 million market cap.
It's a fantastic set of potential re-rating events. Okay, but let's move to the third platform, which might be the most unique one, the digital asset pivot through Vivo Federation.
This is a really interesting structural move. They've executed a definitive joint venture with a company called Lean Ventures.
And they're a licensed Korean asset manager.
They are. And the scale of this JV is huge. They're launching a $300 million investment vehicle,
To do what, specifically?
specifically to acquire Ripple Labs equity for Korean institutional investors. And the target here is significant for VivoPower. They're aiming for a net economic return of $75 million over just 3 years.
And that's all from fees and carry, not from putting their own money at risk.
Exactly. All from fees and carry.
Okay, let's define that really quickly. Fees and carry.
Sure. Fees are just the management fees they charge on the assets, and carry is their slice of the profits once the fund performs well.
So what you're saying is they get economic exposure to the high-growth digital asset world, specifically the XRP ecosystem in South Korea, which is a huge market.
A huge regulated market.
Without having to commit their own capital, they're like a fund architect, collecting high-margin fees for arranging the deal.
It preserves their balance sheet, and it could generate tens of millions in high-margin revenue every year. It's a path from almost no revenue today to substantial fee revenue in the next 2 to 3 years.
Okay, so now let's talk about the stock itself. The volatility suggests that, event-driven funds are already watching this closely.
Oh, absolutely. The stock is extremely sensitive to any news. After they announced the Ripple Labs JV, for example, the stock jumped, 12 or 13% intraday?
So it's completely decoupled from the broader market.
Totally. Company-specific news drives all the price action.
And the catalyst calendar looks packed. What are the near-term events people should be watching?
Well, the annual general meeting, the AGM, is set for December 15th. And management has explicitly said that the meeting might be adjourned.
Adjourned.
Yeah, to accommodate a potential material corporate transaction that could affect shareholders. It's about as big a signal as you can get that news is coming.
And that's not even counting the M&A interest, the $180 million non-binding takeover approach, where diligence is already done.
Exactly. So you have the Carrot IPO filing, the Tembo SPAC completion, the scaling of the Ripple JV, and a potential corporate transaction. The stock is just set up for continuous potential spikes.
Okay, this all sounds like a dream scenario. We have to spend some time on the bear case. What are the material risks here? You can't juggle 4 huge corporate actions like this without major hurdles.
The primary risk is, without a doubt, execution. The entire bullish thesis rests on successfully closing and scaling these really complex multi-million-dollar deals, the IPO, the SPAC, the JV scale-up.
And isn't there a risk of just deal fatigue? I mean, management is running 4 massive transformations at the same time.
It's a huge challenge.
Yeah.
Any delay, any valuation getting downsized, or, an outright cancellation of one of these pillars could severely depress the stock price.
And what about the financials? You said free cash flow is still negative. If these deals stall, how long until they need more funding?
That's the fundamental financial risk.
Yeah.
Now, they are relying heavily on structured equity deals to fund this turnaround. They're cutting debt by swapping it for equity, retiring shareholder loans. But that always brings up dilution risk.
Of course.
It does. But to their credit, management has been clever about it. The recent private placement was priced at $6.05 a share.
And the market price at the time was?
It was below that, so they priced it above the market. That kind of structure actually offers valuation support instead of being this punitive thing for existing shareholders.
That's a really critical distinction. And what about the crypto risks?
That's the last piece. The digital asset exposure, while it's a fee-based model, still introduces regulatory and sentiment risk from the crypto world.
So if the XRP price or the rules in Korea change?
It could impact their ability to generate those fees, but because their exposure is mainly through fees and carry, and they've partnered with a licensed local asset manager, the direct financial damage is somewhat limited.
Okay, so let's synthesize all this. The financial foundation is still solidifying, but the value of the separate assets carrot at 308 million, Tembo at 200 million, and the JV targeting 75 million in fees, it's just orders of magnitude larger than the company's current $40 million market cap.
It is a textbook speculative position. It's for those looking for high-risk, high-reward asymmetry that's based entirely on these event-driven repricings.
And what's fascinating is just the sheer number of shots on goal they have.
Right. If just one or two of these catalysts hit the IPO, the SPAC, the takeover, the potential re-rating is just substantial. It could turn this distressed microcap into an asset-rich special situation that the market hasn't priced in yet.
So the ultimate question for you to mull over is this. Can one management team really execute 4 simultaneous complex corporate transactions, or will the sheer complexity crush the timeline? It's a race against the calendar. If you found this discussion valuable, be sure to subscribe to Investing Talk podcast for more in-depth company analysis.